Hey guys, just wanted to share with you a question I get quite a bit, and it has to do with real estate investing and should you take money out of your pocket and pay additional to being upside down between the mortgage and the rent amount. So oftentimes what I have is owners will come to me and they'll say, what will my property rent for? And we'll tell them what the market dictates. So let's just say, for example, that was $2,000. They'll say, oh, I can't do that because my mortgage, taxes, and insurance is actually 2150 or something along those lines, and they'll say I'm out of pocket $150 a month, so I can't do that as an option. And on the premise, if you are a real estate investor and you're primarily looking at the property as an investment and you were purchasing the property, you absolutely would not want to be upside down on your cash flow on a monthly basis. So you'd want to make sure all these costs are factored in. But something else to look at is if it's not primarily going to be an investment property. It could be if it was a shorter term investment or even a long term investment property, it could be beneficial to use as essentially not inflation proof, but something that's keeping up with inflation as you're putting your money in, giving you potentially a better return on the asset than putting the money in a 401k or putting the money in the stock market. So I just wanted to break down some simple math here, not to get overcomplicated. There are a ton of things to take into account when you're talking about real estate, when you're talking about investing. But overall, we're just going to try to break this down, make it as simple as possible. We're going to take in some very standard ideas here. Standard idea here is we've got a $300,000 house that was recently purchased, and for whatever reason, the person is having to move from the property and looking for, is it going to rent? Is it not going to rent? What's it going to rent for? And is it better to just put it on the market and sell it? Or does it work if I'm upside down, having to come out of pocket to pay for this thing? So we just want to walk through that scenario. The assumption here is there's conventional lending on the property, 5% down. So we've got a mortgage of $285,000. So let's go ahead and get into this, take a look at it. So first thing, we've got our $300,000 property. So this is our house, if you will. That's the value. And over here, we've basically put $15,000 down. So this is, I'll just call this out of pocket. And one of the things to think here is you'll say, well, what about closing cost? We had to roll that in or not roll it in, or maybe the previous seller of the property paid for that. I don't know the exact scenario. I'm just trying to oversimplify this and say $15,000 actually came out of your pocket for the purchase of the property. We're assuming that you didn't make any capital improvements to the property. So again, there's some assumptions being made here, but wanted to share that with you. And then we'll look over here and we'll just say stock market. Or this could be your 401k, could be a mutual fund. And just looking at what the average returns are on this, you can look online and look at what the last 50, 80 years of returns have been. Typically, pretty much anywhere you look, it's going to say average returns are probably 8 to 10%, somewhere in that range. Obviously, they've got highs and lows. They go up and down. House prices go up and down. So we'll just say 8% is general rate of return. So one of the things that normally trips people up when they're looking at, like, hey, I've got to come out of pocket $100, $200, $300, even as much as $500 a month on the property, and not wanting to do that, is just understanding rate of return in the dollars. So if I'm going to get on average, again, you can look this up pretty much anywhere online, the last probably 70 years of home price appreciations have been 1.3% to 2% appreciation. That's a U.S. average. It's not market specific. Obviously, there's some markets that go up. Actually, most markets go up. Some of the markets go down. We all saw in 07, 08 when the real estate market went down pretty significantly. But if you look at over a 100-year span, real estate has tended to go up at about 1.3 to 2%. So this is appreciation on homes USA. So what we look at here is a lot of people say, well, I want to sell the property, whether they can or can't sell the property, and they're looking to either just get out from under the mortgage, or they're looking to take any money that they've got that they may get from the equity in the home and potentially roll it over into something like this in the stock market. And the thing that is oftentimes missed is that people will say, well, I can get a higher rate of return than this 8%. I can get 12%, 15%, 18%, the sky's the limits. And the truth of it is, there are things out there that significantly go up in value, but if you're looking at averages long term, you're basically going to end up around this 8% range. The problem is, if you're making 8%, we'll just call it even 10% for simple math here, on your $15,000 here, you're only making basically $150 a month, or sorry, $1,500 a year. So this is a year on the money, okay? So that's $1,500 if you were to invest that and you got 10% return. Whereas people say, well, what if I had to put money into this property here in order to keep it because the rent was not completely paying for the mortgage, taxes, and insurance, and the maintenance upkeep, or the vacancy cost, or the management cost? What if it wasn't paying for that? What if I had to come out of pocket $200 a month on this property? So we're talking come out of pocket $2,400 a year on the property. They say, well, that's a lot of money. And yes, it is. But what you're looking at here is, if you had we'll just use 2% for simple math here, 2% appreciation on a $300,000 asset, that would essentially say that this property is going up in value by $6,000 a year. And what I would say to anybody that says, well, I've got to pull money out of my pocket to keep this investment going because the rent doesn't pay for the mortgage, taxes, and insurance and some of the upkeep, I would just say simply, would you trade $2,400 for $6,000 on an annualized basis? Granted, this is equity. and you don't have direct asset access to that cash without selling the property. But I would venture to guess that if anybody came to you and said, if you give me $1, I'll give you 2 back, or if you give me $1, I'll give you 3 back, you would say yes to that equation. And that's essentially what's happening here. So obviously, if you extrapolate this out over several years, there's compounding that goes on here, and it would be an added benefit. The other thing you can look at here is you could say, well, but Chris, what if I was getting this rate of return on the money I put down and I was funding the $200 over here? I would have $2,400, which is just directly from there, which is your $200 a month here. So you're going to end up with $3,900 in some investment that's likely not liquid, that, because you're going to have it in a mutual fund, 401k, stock market, something to be getting the return on it, because the bank's not going to give you that. But this is where you would be. You would be at the end of year one, you would have had $3,900 here in an investment tied up, where had you held on to the real estate and looked at the real estate as an investment of your monthly money as opposed to a cost, you would be looking at basically having $6,000 increased in your investment here in the real estate. So pretty obvious, if you take this out just one more year, you would have your $306,000 here that would be increasing in value by, again, your 2%, which would be another $6,000 and $6,000 and some change. So you would be about $312,000 investment. That's year two. And say you do the same thing here, add another $2,400 there. So you'll end up with $6,300, and then obviously you had your rate of return. We'll say it's $1,500 again, just simple math here, guys. So if you had the money in another vehicle other than the real estate investment, with the real estate, you're getting the benefit of the tenant paying down the principal amount of this mortgage, even if the money is not covering everything. So you have basically a tenant that's paying off your investment to a certain degree. You're helping fund your investment vehicle here with some cash flow. It's negative cash flow, but it's a better overall return on your money than putting it somewhere else. Because you can see here, you've got essentially $12,000 in equity there, whereas you would have had, roughly, call it $8,000 there. So that's just year one, year two. Obviously, it extrapolates. Trying to oversimplify this, again, you've got tax benefits as a landlord or a real estate rental owner. So you get depreciation that you get to write off on taxes. This is a business that you are running, so there's additional benefits there. And you also have additional benefits of residents or tenants paying down the mortgage as you go along. So there's some really big benefits to rental real estate. And the other thing that's a big benefit that a lot of times is missed, if this was your primary residence when you bought it, the lending criteria is much, much less, much better than if you were a quote-unquote investor and trying to go buy a rental property. As a home owner that's going to live in a property, you can typically get into a property like this with conventional lending with 5% down. That's where we came up with our $15,000 out of pocket. So, and you typically get a little bit better interest rate, sometimes 1 to 1.5% better interest rate. So there's better lending on conventional mortgages that are going to be your primary residence. As your situation changes, it may turn into a rental property, but initially you get the benefit of primary residence, lending, and standards, whereas if this was going to be a rental property and you were going to have to go out into the lending world and get a loan on the property, you're looking at a minimum of about 20% down on the property. So that would take you from $15,000 to get into basically purchasing a rental property and having leverage, up to about needing $60,000 in cash to purchase the same property, and the interest rate would be slightly higher. So there's some really big benefits to turning a primary residence into a long-term rental, just looking at the math of it over time. So there's a lot more in depth that goes into this. There's CapEx expenses, there's maintenance expenses, there are legitimate costs to owning rental real estate. However, I just wanted to try to make this as simple as possible for those people that come and they say, hey, I'm going to be upside down. There's no way I can be upside down on this monthly and make it work. If you just change the idea of being upside down to I'm actually funding my long-term investment, it could be as little as $50. It could be as much as $300, $400, $500. Just go through the math and look at it. The math will tell you whether it makes sense or not to keep something as a long-term rental. And also your personal financial situation will tell you that as well. Because again, there are costs to being a landlord, but there are also significant benefits to you financially. So hope you find this helpful. Take care.